Hey everyone, Darrell here from the Wealthspire Investment Team with the February installment to our Markets in 2 Minutes series. This month we are going to shift our focus to private credit markets, where we've seen an uptick in media headlines that have raised concerns about risk-taking and liquidity. Those headlines painted the market with a pretty broad brush of negativity that we wanted to opine on here. Now, we posted a long-form blog on this topic earlier in the month, and we would encourage anyone interested in a more detailed overview to take a look at that. But this video is going to highlight some of the key takeaways from that piece. Broadly speaking, the headlines were initially sparked by a couple of high-profile defaults that transpired back in the fall, and things sort of cascaded from there, with the message ultimately zeroing in on the idea that these defaults may ultimately prove to be a canary in the coal mine type of scenario. The first thing we would highlight, though, is that the two most discussed failures, which were Tricolor and First Brands, were not actually private credit deals. They were primarily underwritten by banks, but were erroneously attributed to private credit risk-taking in the mainstream media. But that doesn't mean that there aren't risks that investors need to be aware of. The first key development that we've observed in the market over the past few years is an increased usage of so-called payment in kind loan structures, also referred to as PIK loans. And PIK loans allow a borrower to defer interest payments until the end of the loan period, thereby decreasing the size of their regular payments. So borrowers are effectively trading smaller payments for a higher amount of total interest owed over the life of the loan. And generally speaking, PIK loans are seen as a signal of borrower stress, especially when they're added as an amendment after the initial deal has already been agreed upon. And according to the data we've charted out here, the percentage of loans in the market that carry PIK has increased from 7% to 11% over the past 4 years. And in many cases, that PIK feature was added as an amendment to the loan structure. So on the surface, that's something to watch, right? There are more concessions being made to borrowers across the market. And at the same time, we're seeing spreads and yields moving lower, which means that lenders are getting paid less for providing capital as compared to a few years ago. So on balance, we're seeing some signs that there's been an incremental shift in underlying risk, and at the same time, the compensation that investors are receiving in the form of yield is lower. But what we want to emphasize here is that these are incremental shifts rather than signs of broad stress. Investors are still looking at yields in the 10% range, which is a return expectation that is commensurate with risk taking. And that means private credit is still a viable investment. But going forward, the environment is going to be a little bit more challenging for investors because that trade-off between risk and reward is now a little bit more balanced. And investors should look forward with that in mind. Thanks for joining us.